Number 10. If returns are going to be 7 or 8% and you're paying 1% for fees, that makes an enormous difference in how much money you're going to have in retirement. Since cost matters, a passive form of investing could be the best path to take to build wealth. Return on investment is an approximate measure of an investment's profitability. ROI is calculated by subtracting the initial cost of the investment from its final value, then dividing this new number by the cost.
Number 9. Never invest in a business you cannot understand. Warren Buffett has always held strong to the belief that index funds are one of the best ways to grow wealth. They are inexpensive and are not closely linked to how well one entity is predicted to fare. Index funds are investment funds that follow a benchmark index, such as the S&P 500 or the NASDAQ 100. When you put money in an index fund, that cash is then used to invest in all the companies that make up the particular index, which gives you a more diverse portfolio than if you were buying individual stocks.
Number 8. Risk comes from not knowing what you are doing. The advice here is obvious but often forgotten, particularly after investors have had some success. The temptation to believe that success in one area you know well allows you to easily analyze another is much greater once you've had some good returns, but should be resisted. Warren Buffett himself has kept out of the technology sector for the most part, given his lack of knowledge of the sector.
Number 7. For the investor, a too high purchase price for the stock of an excellent company can undo the effects of a subsequent decade of favorable business developments. If you pay too much for a company, your investments might take a hit later on. Investors who believe a company will be able to increase its earnings in the long run or who believe a stock is undervalued may be willing to pay a higher price for the stock today, regardless of short-term developments. Although high-priced stocks have chances of going down, they give very high returns most of the time. In case the price goes down due to rights or bonus issues, they recover and give decent profits. So it would help you grow the investor's money many times.
Number 6. Beware the investment activity that produces applause. The great moves are usually greeted by yawns. This is sage advice from a man who has made a fortune on companies like Apple, Reliance, American Express, TCS, General Motors, UPS, Johnson & Johnson, MasterCard, and Walmart.
Number 5. Price is what you pay. Value is what you get. Don't focus on short-term swings in price. Focus on the underlying value of your investment. Swing trading is a style of trading that attempts to capture short to medium-term gains in a stock over a period of a few days to several weeks. Swing traders primarily use technical analysis to look for trading opportunities. Investing in the stock market is that investors get the chance to earn more money. Over time, if the stock market rises in value, the prices of a particular stock can rise or fall. However, investors who have put their money in stable companies will see profit growth.
Number 4. The most important thing to do if you find yourself in a hole is to stop digging. Investments can go bad, and when they do, it's best to bow out and stop throwing money at them. It is a difficult decision to make, but accepting the loss will prove to be more beneficial financially. Bad investment is an investment in which you do not make a profit, or make less profit than you hoped.
Number 3. Should you find yourself in a chronically leaking boat, energy devoted to changing vessels is likely to be more productive than energy devoted to patching leaks. Averaging down is only effective if the stock eventually rebounds because it has the effect of magnifying gains. However, if the stock continues to decline, losses are also magnified.
Number 2. Remember that the stock market is a manic depressive. For any consumer of daily financial news, this will ring true. Equity markets swing wildly from day to day on the smallest of news, rally, and crash on sentiment, and celebrate or vilify the most inane data points. It's important not to get caught up in the madness. Instead, stick to your homework.
Number 1. Rule number 1. Never lose money. Rule number 2. Never forget rule number 1. But, it is possible for the stock market to price things wrong. You can find wonderful businesses on sale often. Invest only in value stocks and have patience to wait for longer period when prices are coming down, then you never lose money.
Thank you for watching.